maybe can you start out by giving some info about your personal background and what ultimately brought you into the industry and what led you to build Supernova?
Yeah, so my background in CS and econ, and then I bought my first token in 2018, and then in 2020 and 21, when I saw that Uniswap became somewhat usable and it had good liquidity, that's when I realized I'm probably going to spend the rest of my career in crypto. And then so in 2020 and 21, I was actively trading and then running sniping bots and farming on chain. And then after that turned out to be quite fruitful, I worked at Blockchain Capital and Bain Capital Crypto. My interest was also mostly DeFi and liquid. And then after that, striked out on my own. First built a merchants payment app. We raised some money from Andreessen, but eventually realized that stablecoin merchants go to market isn't our strong suit. So we went back to our root. So Supernova was founded uh, mid last year, and then now we are a team of 6 people. And then just launched our private beta yesterday. And then I think yesterday we have already gotten 100 million in trading volume.
That's a lot of adoption right from the get-go. I mean, that's quite impressive. So what was the initial problem that you identified, and what's the basic idea of Supernova? Maybe also because in your X bio you have that you're interested in building Turing complete markets. Maybe if you're able to bridge the gap there, how that relates to this tagline, and what do you mean with that?
Yeah, for sure. So Turing complete essentially means that in the computer science world, it means any computation or functions can be expressed. And in my context, I was referring that to the market, meaning that in a very robust and complete market, anything should be hedgeable or tradable, especially some important numbers. For example, interest rate is one of them, and then FX is another that we are seeing a lot of demand on. So you can understand Turing completeness as you are not stuck at a market or a position without being able to hedge it out or express your views.
So as of right now, what would you say are these markets where there is a need to hedge them out, and where would you say you already have options available of what is being traded on chain?
Yeah. So we are seeing tricky dynamics on these money markets protocol. So for example, Aave or Morpho. And then I specifically call them money market protocols because they are serving both the lenders and the borrowers, right? But actually, colloquially, I don't know if it's intentional or not. People tend to call them lending protocols. And then I think that's actually very accurate because right now they're only serving the lenders. And then so our goal with our interest rate market is to help these lending protocols to also serve the borrowers well. So what does that mean? Let me dissect that. So in general, lending money market protocol, lenders tend to prefer variable rate, and then lenders also very much value the flexibility to withdraw at any time. But on the other side, borrowers always care about predictable cost of capital, and then that's consistent in TradFi as well as on chain right now. I would say maybe 2-3 years ago, people wouldn't on-chain money who are borrowing from Aave because the activities that they engage in are so speculative that no one cared about fixed rate borrowing. But as you have more private credits, you have more fixed income on chain. Fixed rate borrowing is just going to be the future that most loans denominate in on chain. And then we have seen this in private credits. All the borrowers borrow at fixed rate. If lenders lend at fixed, then they will use an interest rate swap to hedge out their rate exposure. so essentially we are bridging the gap that borrowers want fixed rate, lenders want variable rate, and also the flexibility to withdraw. And then this gap is getting widened and widened in the past few years. So if you talk with these institutional borrowers who are borrowing off chain from Galaxy or Maple, they're paying somewhere between like 200 bips to 350 bips just to get fixed rate. And then when Aave rate is 4%, that's a 70 to 90% premium.
Yeah, you published an article on the necessity for fixed rate borrowing a few days ago on X. I think that gained quite a bit of traction, and that's how also I initially came across Supernova. So as of now, what would you say are people already able to do? Because I think the initial impression of when somebody hears who's somewhat DeFi native, oh, you're building in the fixed rate and rate swaps space, don't we already have this with protocols like Pendle or protocols like Spectra? So how do you differentiate from them, both in terms of the mechanism design, but also in terms of like what investor base and what use cases you're catering to?
Yep, for sure. So fixed rate, so we are very different from Pendle and Spectra. So they are working on the fixed rate lending or the fixed income side. We are helping borrowers to get a fixed rate, not the lenders. And then, so actually fixed income is one of the steps that had to happen before fixed rate borrowing become prominent on chain. So as we all know, right, like before, like TradFi market is full of fixed income products, but on chain we didn't have any fixed income till 2024 when Pendle worked with like these LSTs to bring PT into the market. So so that I hope that helps with understanding why we're different. And then we can also talk about like fixed rate borrowing. There were previous attempts on fixed rate borrowing, but the form factor, the market condition, why it didn't work before, and what we're doing different. Do you think that could be interesting?
Well, do you think that in order for Supernova to take off, does there have to be a significant change in the types of capital that is being used as collateral and also in the types of investors that are active on chain? Because I would say that in the past, given that you had rather volatile collateral, I mean, even BTC and ETH had a very high like implied annual volatility. Of course, that has decreased a little bit, maybe picked up a little bit over the past couple of weeks, but I mean, the trend had been downwards. I mean, what you already hinted on at the beginning, there wasn't really that much of a necessity for fixed rate borrowing because people were engaging in very speculative activities who were on the borrower side, but also on the lender side. I mean, as long as you have to be over collateralized, what has to change on that side of the market in order to like incentivize more borrowing, or does there even have to be any change on the lending side?
Yeah, the lending side. So our whole goal is to not change the lending side because the lending side has done a fantastic job serving the lenders. Right now, if you lend to Morpho or lend to Aave, right, you can withdraw at any time. Your collateral stay with this blue chip protocol that has been battle tested for 4 years or 5 years. Everyone now say that just use Aave, right, or the Morpho way, because institutions, especially people with sizes, they only trust these blue chip protocols. So we don't want to change anything on the lender side. Supernova's interest rate market, the whole goal is to help borrowers get fixed rate from these protocols that they're already familiar with.
So who's your primary, let's say, customer or client base? Is that mostly organically driven? Are you trying to directly connect lenders and borrowers, or how does your go-to-market and growth work right now?
Yeah. So we don't need to talk with any lenders because they're just lending to Aave, and then borrowers also directly borrowing from Aave, and then they come to Supernova to get their rate fixed. So they exchange their floating rate for a fixed rate. at Supernova. So on the borrower side, there's a few group of capital that wants fixed rate borrowing. So actually, if you think of who's actually borrowing on Aave right now, right? I would say there are two groups mostly. One is the looping strategy capital, and then the second is the high net worth individuals, whales who are borrowing against their majors to get stablecoin liquidity. That's it. So it's just these two groups. I don't think your average retails are actually borrowing from Aave for a third reason. So out of these two, right, looping and high net worth borrowing against major, I would say the first group right now accounts for about 70 to 80% of the total borrowing demand on Aave, and then the second category 20 to 30%. Right. So looping strategy will be our first group of customers.
But I assume the large share of the loopers just comes from them leveling up, right? They're not necessarily the larger base input of capital, right?
No, the loopers are putting down their, for example, Ethena, SUSD, USD, or PTs, and then borrow USDC against that. And then that group of capital want fixed rate borrowing. My co-founder and I, we used to run looping strategies ourselves, and then it's you often run, some of these loops tell you that, okay, let's say SUSD is 5%, Aave is 3, you can loop it up 9 times and then get a 20 to 30% APY. That's rarely the case, actually, even if you're using PT as your collateral, because when your Aave borrowing rate is so volatile, you actually, sometimes your loop can be in the red when you loop it to such high leverage. So, yeah.
No, over in the DeFi dojo, we are very actively looping up pretty much everything. And I mean, whenever there's a rate spike or Justin Sun withdrawing another couple of 100 millions, it's always a lot of activity over in the chats. So yeah, I do think that this is going to become more interesting going forward. How would you say has the rise of curated vaults and curators in general affected the entire rate space? And would you say that there's, in terms of what you're trying to cater to with Supernova, are you kind of building a single standing protocol, or are you basically trying to tap into existing rates on, for example, Aave, Morpho, Euler, and these lending protocols?
Yeah. So we define ourselves as a rate exchange. We're not building a lending protocol. And then the fixed rate borrowing is just one of the use cases that we see of a rate exchange that is very in high demand. So and then to answer your other question regarding the vaults, right now, so actually we work pretty closely with these risk curators. I don't know if you follow that, Morpho V2, Euler, Camino. This is also in my article. They are all trying to do fixed rate, and then they are doing it as a P2P fixed rate. So in order to support, let's say, 100 million worth of fixed rate borrowing, you need to source 100 million of liquidity that are willing to be locked up in these markets for, let's say, a month or 3 months, right? And then I think that's going to be very expensive to source on chain, because on chain capital, they all prefer the flexibility to withdraw at any time way more than the off-chain capital. That's just like a matter of fact. It's getting better, but on-chain capital always prefer the flexibility to withdraw. So with these vaults, they're getting into a somewhat tricky position. So the risk curators, it depends. So I don't want to quote a specific number because it depends for each risk curators. But the long story short is that they can't put everything into these fixed rate loans, because they also want to satisfy instant withdrawal for their depositors, right? And then so if they can use, let's say, half or 40% of their vault for fixed rate lending, they also need a place to hedge out their interest rate, because they don't want to be stuck into a low fixed rate, and then let's say the variable rate go up, and then all their depositor wants to withdraw and then deposit into a variable rate market, because their fixed rate become not competitive. They don't want to ever be stuck into that position, because that will lead to can't withdraw, and then a state of withdrawal, they may need to liquidate their fixed rate lending position, and that might lead to insolvency.
From the curator side of things, they would use Supernova primarily from a like defensive perspective, right? To hedge themselves against the loop potentially going against them.
Exactly. It's similar to, in TradFi, if you're a lender, if you're lending fixed, you use an interest rate swap to hedge out their exposure, your risk exposure, because you only want to underwrite the credit risk that you're underwriting. So yeah, it's very similar dynamics here.
Let's walk through your beta that just launched. I think it was today or yesterday with the launch of Mega ETH mainnet. So if you want to screen share and take the audience through the kind of mechanism and how the UI of Supernova works, I think that would be pretty interesting.
Yeah, for sure. Let's see it. Okay, so we have two groups of users. One is the hedgers. So these are the fixed rate borrowers who want to borrow fixed on Aave. So for hedgers, we want to make their flow as simple as possible. So we abstract all the, for example, cross-chain or margin management away from headers, such that they can either one click through our front end or one API call to get their rate fixed. So this will auto detect your Aave, your loans on Aave. Right now I have 0, so you can't see anything. But if I, let's say, have a $1 million worth of loan on Aave, it will show that it's all floating rate right now, and then how much do you want to fix it. So let's say I'll fixed rate, and then so currently I'm paying 3.66 on Aave, and then if I get a fixed rate, I'll pay 3.49 for till the end of this month. So if I fix my rate, I will essentially, it jumped up. So if I fix my rate, this is what I will pay if I get it logged in. So
can you dive a little deeper into the math, how the rates are calculated, how the duration is calculated, in which cases it might be lower than the variable rate, or in which cases it might be higher?
Yeah. So as you see, right, this number was changing as we were just talking, because people are trading on the trading market. I will show you later. But essentially, as this number change, if I get it locked in now, whatever the number that I locked in will be my fixed rate from now on to the rest of the duration. And then essentially what you're paying with this rate is that you are paying 3.1 for this duration to buy the floating rate of Aave's borrow rate. So essentially you are now earning the Aave borrow rate no matter what it is. And then that cash flow that you're earning cancel out with your interest rate payment on the Aave underlying protocol.
This almost sounds similar to what Pendle is doing with Boros, where you can do something like that for funding rates.
Yeah, Boros focus on funding rate, and there's a few differences. So funding rate is discrete, but this is continuous. So all the interest rate settles continuously, and then Boros is a great product. We used to run market making bots on their order book.
Nice. Yeah, we recently had a Boros trading competition in the DeFi dojo, and I think that still a very, very niche product for DeFi, but I can definitely see the larger vision there. And like, I've always been interested in rate swaps in general. Back then, I used to co-teach a introduction to blockchain course at my university, and that was in late 2022, and I was trying to convince people of Pendle and like rate swaps and interest rate derivatives coming on chain back then. But yeah, very, very happy to finally see that gain some traction. So in terms of the like how your interest rate is calculated, you
Yeah.
are still very much dependent on the overall market utilization. So it is not something like, let's say, Wildcat or Free Jane or some of the like B2B institutional lending borrowing protocols where you get an interest rate calculated and assigned based on the risk profile of what you're doing, right? So regardless of what you use the money for that you borrow with Aave, the rate you can lock in is still dependent on the, let's say, collective behavior of both the lending and the borrowing side, right?
Yeah, exactly. Um, we define ourselves as rate exchange, so we are not. So for example, Wildcat or Three Janes, the ones that you described, they are more credit markets. So as Cap protocol, they're more credit markets or lending protocols. Um, yeah, so we are not in the position of facilitating these loans. We're more in a position of any money markets. We can build a rates market on top of them to
Hmm.
help them get a fixed rate. Um, and yeah, and
So
then actually in DeFi right now, most loans are priced on a utility curve, and then everything is floating rate. But I do think that utility curve is the best way to price uh, a loan on DeFi, right? Because you want to make sure that when utilization runs too hot, you need people to have incentives to deposit or withdraw, vice versa.
hmm. So would you also be able to build on top of the likes of Cap or Free Jane or Wildcat down the road? I'm not sure if they already have fixed rates for whatever they're offering. But yeah. So
Yeah.
what's the roadmap for integrating into other protocols? Also, because I would say that the the types of users, especially on the side of Wildcat and Cap, who are a little more, let's say, sophisticated in the
Mhm.
sense that they are much more aware of rates than like the average crypto OG who's just like borrowing stables against his ETH position on Aave. Are you
Mhm.
trying to specifically cater to certain protocols over others, or what's your outlook there?
Yeah, yeah. So when it comes to credit market, it's especially important that borrowers want fixed rate because it's usually that the institutions borrow on credit, and then credit rates go somewhere between 13 to 17%. When you are paying such high interest rate, right? Everyone wants fixed rate. And then yeah, so we're working pretty closely with Cap Protocol. They are a credit market that's lending to institutions like Amber, Sig, Flow Traders, IMC Trading. When these parties borrow from them, they want to price the loan based on a utility curve because of the dynamic I just mentioned, right? But on the other side, these institutions also want fixed rate. So in order to do it fully autonomously, instead of always having people discussing loans details and rates, which became the TradFi. If we do it that way, then become the TradFi, people to people facilitating this. Um, if you want to do it fully autonomously, it has to be on the utility curve, and then a rate swap will be on top of the utility curve to help institutions better price their fixed rate borrowing. And
Hmm.
then yeah, and then for Wildcat, it's also a great team, a team that we have been closely following. Right now, they're doing the P2P fixed rate credit. So essentially, lenders and borrowers discuss, okay, or lenders, the borrowers will specify a rate, and then the lenders will decide whether they want to lend it or not. Um, and then but yeah, I do think that in the future these curves will be more uniform, will be priced more in a unified way. So it would be less of the P2P, lenders need to talk with borrowers to determine a rate. And then if you do it on an order book, I'm just not sure if we currently have enough sophisticated capital that are willing to actively quote on this market.
What do you think would need to happen to the market participant base in DeFi, and also maybe to go a layer deeper, what yield sources would have to be enabled on chain to get people to participate in DeFi who are like essentially dependent on having access to rate swaps?
Yeah, yeah. So a few categories, as I just mentioned, the looping strategy capital, as well as institutional borrowers who are currently borrowing from Galaxy, from Maple, and then or even Galaxy and Maple themselves want to source liquidity from on-chain, because we as I mentioned before, right, on-chain has a lot of TVL that are lending, but not enough borrowing demand, and then that just makes the on-chain capital a lot cheaper than the off-chain capital. And then so all the institutional borrowers want to tap into this if they can get a fixed rate. And then on the other side, there's also credit market. Right, all the borrowers want fixed rate. So in order for credit market to grow, I think and also as these private credits or RWA, like the off-chain yield source coming on chain, it becomes even more and more important that the lenders want the flexibility to withdraw, but the borrowers all want a fixed rate loan, and then you need something to bridge the gap between the two, and then that's where we sit in. So
Can
as we see,
can you explain these different, let's say, parties involved in the transaction on your UI that you're just sharing right now? Like, who influences which of these graphs? Who's taking which side? Who is taking which part of the risk on?
Yeah. So as we were just talking, some people are trading. That's why the rates keep changing. And then so let's go to the 5-minute chart. Yep. Or an hour. Yeah. So essentially, you can long or short rate on this trading terminal, and then we also have a developer-friendly API for people to tap in. And then if you long rate, then essentially you are paying a fixed rate and then get paid a floating rate, and then all the hedgers are on the long side. And then traders can also short rate, meaning like if they think that the Aave floating rate or the fixed rate will go down, they can express their views through shorting. And then both of these will affect where the rate goes. So it's a dynamically priced by the market. We never is the counterparty or the OTC that underwrite these loans.
Yeah. So the graphs that are shown right now, so the orange one, the implied APR, that is basically what the market thinks. So all participants where the Aave APR is going to be on February 27th, or what does the implied APR reflect?
Yeah, the implied APR essentially is the fixed rate cost if the fixed rate cost from now on to the end of the duration. Yeah. And then so the implied APR is dynamically traded. And then the underlying APR is based on the underlying lending market.
So the underlying APR is just what is right now the variable APR in Aave. And I would assume that the average Aave borrow APR, is that a 7-day, 30-day average, or how is that calculated?
So the underlying APR is instantaneous. So it's the current rate from Aave.
And the average one, the white line?
Oh yeah, the white line is the average APR for the visible times on the graph. So if we zoom in and zoom out, it's actually the average of the time span that we're seeing on the graph.
Okay.
Yeah.
So which market movements, shifts in sentiment, or like developments in DeFi would need to happen for the implied APR to move in one or the other way, i.e., what I'm trying to get at is if somebody is new to rate swaps and just wants to try it out and ideally make some money rather than lose money, how can people think about trading these markets, and what are the basic strategies that people are applying?
Yeah. So I would say that rate swap or these rates actually strongly correlate with majors prices. So if you want to long Bitcoin or ETH right now, you can long rates. I think that's a very vanilla strategy that when we run market making bots on borrows, that funding fee, interest, like these Aave borrow rates are all very correlated with major prices. And I would say a second thing is like make sure you understand, for example, if sometimes there's a difference between the implied APR and the underlying. Right now, the difference is not that much. I think there might be some market making bots right now on this that are arbing the difference pretty closely. So let's say, like for example, the implied is 3.83, the underlying is 3.68. So if you are shorting rates right now, you are essentially earning the difference between. So you're paying 3.6s but getting paid 3.83. Well, that looks like a small difference, right? Only 20 bips. But since you are only putting down about like 400, like 380 bips of collateral, that's actually about 10%, a 10% APY.
Yeah. So the way to make meaningful money on Supernova is that you're very capital efficient in what you're doing, even though the absolute swings in the percentage are rather low.
Yeah, exactly. So let's say if the implied and the underlying widen, so let's say implied is 6, underlying is 4, right? If you're shorting in that market, you're actually getting a 50% APY, right? Because you're paying 4, getting paid 6. Yeah.
Yeah. So if you zoom out a little bit, I saw that on the left on the time scale, we had quite a big discrepancy between the implied APR and the actual borrow APR.
Yeah.
In what scenario does something like that happen, and who is then incentivized to take which side of a trade?
Yeah. So this is actually a relatively abnormal situation. I think this is before we opened the market to the public. So we were trading internally, and then the liquidity got a little crunched in that. But normally, if this happens, it's a great time to short the implied rate, and then that's what we did. So as you see, it dropped immediately. Yeah. So in the case, so it's actually pretty simple. So essentially, it's when the implied APR runs high, that means that there are too many longs in the market, and then when it drops, that means so if we are here, then that means that there are too many shorts in the market.
So basically, when the implied APR drops below the actual borrow APR, and you are a borrower on Aave, then you have an incentive to go long the rate, because that way you can fix your rate below the actual rate, right?
Yeah. Well, it doesn't have to be below it. Usually, it's actually above the actual rate.
So in what scenario would it drop below the actual rate? Is that essentially when the market sentiment is very bearish and people would expect rates to be lower when the market expires than they are now?
Yeah. So let's say Justin Sun withdraw 100 million of liquidity on Aave, and then the rating instantaneously shoot up, right? So now the purple line, the Aave rate, will be like, let's say here, and then the orange line then will be below, right? I do think that the implied in that case will rise a little bit, but maybe not go above the purple, because the market are thinking that, okay, this is a one-time trigger that pushed the rates up. It will go down either by borrowers pay back their loans, or more lenders or depositors depositing because the rates is higher. And then so if the market is betting on that, the underlying rate will oscillate back to the normal level from now on till the end of the duration. Then you will see the implied be temporarily below the purple line.
Do
And
the
then
mechanisms differ at all when you're dealing with yield bearing or volatile collateral or markets? Let's say you have staked USDE or any of the, let's say, SUSD AI or a lot of the yield bearing stablecoin instruments. Are they applicable to these markets too, or not really?
yes, we are opening some of the PT markets on Morphle after Aave. So that those markets are relatively, compared to Aave, a lot smaller in terms of the loan size and also the amount of liquidity in it. I would say in those markets, like a 50 mil or 20 mil market will be considered pretty sizable. And then those markets are more, I would say, more influenced by the PT YT yield dynamics. So if people are all of a sudden speculating on YT because of some news, then the PT rates will go up, which in the case pushes the borrowing rate on Morphle to go up. And then
So in that
yeah.
case, you might be able to see more frequent and also more significant divergences between the implied APR and the actual APR, because people have that additional variable not only of speculating on the utilization, which informs the borrowing rate, but also on essentially how bullish they are on the airdrop that is incentivized on the YT side.
Yeah, and I would say for example, private credits, if we run more loops on that, that will also be influenced by, for example, the underlying yield. What is it yielding, and then what does borrowers want? So I would say each specific market, especially for these smaller markets, it depends on the parameters of the risk curators, the borrowers, the fixed rate of the yield bearing collateral.
What would you say is the rough size and activity of a market in order to become relevant for Supernova? Because on Pendle, for example, where you have most of the yield-bearing stable trading going on, if you look at Ethena or if you look at USD AI, I mean, their TVL is often in the hundreds of millions, which for TradFi standards is nothing, but for DeFi standards is pretty high. So would these ones be interesting for Supernova, or how are you positioned on that side?
Yeah. So we are talking very closely with the Ethena team, actually. Ethena right now is one of the most looped product on chain, and then they are very familiar with how, if you are borrowing at a floating rate, that hurts the profitability of your loops, and then in that case, that discourages people from looping aggressively. So we do think that all these assets issuers that are issuing yield bearing assets, and also they all want to help their borrowers to get the borrowing rate fixed, as well as these LSTs who, for example, EtherFi or Lido, when their users are borrowing against large holdings of these LSTs, their holders also want to get a fixed rate.
Can you already shed some light on the vaults feature that is visible on your screen share?
For sure. Yeah. So the vault is actually very profitable in the past day, but this is it's an APR, so it's only for one day. It was quite profitable. So essentially, this vault is providing liquidity to the market, and it allows passive liquidity providers to deposit into it. So in that case, what I mean is that, so on the market, you see that there's a there's an order book, right? So and then we also, so when we built the market, we also designed a customized VAMM on like that runs in parallel with the order book. So in the case of the order book might not have the best price or the best liquidity, trades will settle with the VAMM, and then the vault will take the other side of those trades, and then also
So it's
earn
somewhat
trading.
similar to HLP on Hyperliquid.
Yeah, it's similar to HLP, but it's it's different in a sense that we don't actively market make on the HL in the with the vault. I do think HLP does active market making,
Yeah.
and then
So
yeah, so
basically, your vault only steps in if there's not enough liquidity, right?
exactly, yeah, and then our vault earned a trading fee for those transactions, if that's the case.
Hmm.
And then yeah,
Is
and
that
then in
how
the,
Supernova makes money through trading fees, or what does your revenue model look like?
yeah, our revenue is three ways. So trading fee, and then there's also the settlement fee, which essentially charges users based on the amount of time that they hedge. Trading fee is one off when you open or close a position, and then there's also institutional API access that we will charge a fee on.
Hmm.
Yeah.
What are the trading fees and the settlement fees like? Like, do you basically have to be very opinionated on a certain rate in order for you to be like participating with like a positive EV, or is it like a very minuscule fee because you expect a lot of trading activity and also a lot of size per trade?
Yeah. Um, so so right now we're charging 5 bips on trading fee, and then 15 bips on the settlement fee. And then yeah, I would say because this product has such high inherent leverage, 5 bips is it's actually it's a relatively fair fee on the trading side. And then you don't need to be so opinionated. Um, the rate doesn't need to go, let's say, from 3 to 7 for your longs to be profitable. But we also don't want to encourage toxic behaviors um, that might tilt the market to, for example, um, if we charge no fees on trading, then and then if there's like early incentives on the market, then that might tilt the market to unhealthy levels. So we want to prevent that from happening as well.
How would that look like? Like what, I mean, since you're much deeper in the whole rate markets concept, you've probably thought about that. So if you wanted to, let's say, manipulate a rate market, how would
Yeah.
you do that? Why would you do that? And like, what would success or failure in that case look like?
Yeah, yeah. So I define the failure of the rates market as the implied significantly doesn't really reflect the underlying RA borrow rate, right? Because in that case, the hedgers can't really use it as a hedge if the implied rate is like at 8 and then the underlying is at 3. Um, so we want to prevent that from happening, and then we also want to prevent, for example, if they are very diverged, there should be enough incentive for people to arb them together, so bring them closer together. So we also want to make sure that there's no hurdle on that. So if, let's say, the implied is at 8 and then you're shorting, like very very likely that your trade will be in the green. So I'll say that's the basic of it, and there's some like nuanced details that I think you only see when you market make on these market.
Hmm.
Yeah.
What is your roadmap like for the next weeks and months? What features can we expect? And also, how would you say does that tie into the launch and growth of the Mega ETH ecosystem?
Yeah. So we are going to, this is our first market of a USDC borrow rate, and then we're going to launch a Morpho market soon after this. On Morpho, we are prioritizing the PT markets because those looping strategy are they demanded the fixed rate borrowing the most. And then after that, we are also working closely with cap protocols to launch a instant on their borrowing market. And then product roadmap, we will continue rolling out these new markets, and then make sure that we onboard these institutional customers and looping strategy capital. And then we also have a developer friendly institutional grade API that's coming soon. So once that's released, then institutions can use this API to call and fix their rate, or traders can also use this API to trade on the market.
So if people are interested in learning more about Supernova, where can they find you guys and how can they reach out?
Yeah, so on Twitter we are Supernova Labs or the Supernova Labs _. And then, or you can follow me on Twitter. I'm Nico YPEI.
Very nice. Maybe you obviously don't have to answer that question, but are there plans for a points program and for a token?
Yeah. Yes.
So if people are already participating actively in PTs or lending or looping, I guess they now have another incentive to try you out as well. So yeah, I do think that Supernova is really one of the most interesting ones from a financial engineering and just bringing more financial sophistication into a DeFi perspective of all the protocols that are being built. Is there any other topic you'd like to dive deeper into, or anything you'd like to share with the audience?
I can give you a quick flow of, like, if you're interested in Supernova, where it's a good easy start. I would say definitely the hedging. It's easier to understand. So if you are running looping strategy, I strongly recommend come to hedge and then just one click fix your rate, and then see how your loops become a lot more profitable or predictable after that. And then you want to go deeper, play around with the shorts and the long of the rates, because you can't do this elsewhere right now. You can only do it on Supernova. So yeah, and then also the vault can be interesting if you want if you want to passively participate into the market. Yeah, and then if there's any feedback, I'm all ears. DM me on Twitter.
Yeah, I'll make sure to include all the links in the podcast description so people can find you. Yeah, I mean, I definitely think that your protocol is one of the ones worth keeping a very close eye on. Very excited of where it's going to go. So yeah, thanks a ton for coming on. Was great having you, and hopefully see you soon again on the pod.
Yeah, thank you so much, Max.